Have you heard of DSCR loans but aren't really sure how they work? Or how they let you qualify for investment property loans without using your personal income? Maybe you're tired of lenders asking for W-2, tax returns, pay stubs, all the paperwork that slows you down or holds you back, especially if you're self-employed or already building your portfolio. What if I told you there's a type of loan that doesn't care about your personal income at all, only about how well your property can pay for itself? That's what DSCR loans offer, and in this video, I'm going to break it all down. How they work, how to qualify, and how investors use them to scale their rental portfolios without income verification headaches. I've helped investors, including those who've left their W-2 jobs or have complex finances, use DSCR loans to keep growing. Today, I'll show you how you can do the same. Let's dive in. What is a DSCR loan? Let's start with the basics. DSCR stands for Debt Service Coverage Ratio, and that's really just a fancy way of saying, does this property earn enough rent to cover its mortgage and other loan costs? A DSCR loan is a type of mortgage designed for investment properties where the approval is based on the income generated by the property, not on your personal income, tax returns, or debt-to-income ratio. That means the lender is looking at the property itself as the borrower's income source. They want to know, if this property brings in $X in rent every month, is that enough to comfortably cover the loan payments? The loan doesn't care if you're a full-time investor, self-employed, or someone with 10 other mortgages. It cares about whether the deal works. Picture this. You buy a rental property that earns $2,000 per month in rent. If your mortgage payment, including principal, interest, taxes, insurance, what's often called PITI, is $1,600, that means your DSCR is 1.25. That number tells the lender the property earns 25% more than what's needed to cover the loan. And that's exactly what they want to see. A property that pays for itself and then some. How DSCR is calculated. Now let's talk about how DSCR is actually calculated so you can start thinking like a lender. The formula is simple. DSCR equals gross rental income divided total loan payment. Gross rental income could be your actual rent from a signed lease, or in some cases, it could be market rent as determined by the appraiser. The total loan payment includes everything: principal, interest, taxes, insurance, and sometimes even HOA dues if they apply. Lenders generally look for a DSCR between 1.0 and 1.25 or higher. A DSCR of 1.0 means your rent exactly covers your loan payment. No cushion, no extra. A DSCR of 1.25 means your rent is 25% more than the loan payment, and that gives the lender more confidence that you'll stay current on the mortgage even if something unexpected comes up. Here's something interesting. Properties with a DSCR above 1.25 often help investors secure better terms. Lenders may offer a better rate or allow a higher loan-to-value ratio because they see a safer loan. On the flip side, if your DSCR is below 1.0, you're losing money on the property's debt service each month. And most lenders won't touch that unless you're putting down a lot more cash. What's powerful about this setup is that it shifts the focus from you to the property. It's no longer about how much money you make personally or what your tax returns look like. It's about whether the deal itself makes financial sense. How to qualify for a DSCR loan. So, how do you qualify for one of these loans? First, you need to prove the property's rental income. That could be a signed lease, or in the case of a new purchase or a newly rehabbed property, the appraiser will provide a market rent analysis. This tells the lender what similar properties in the area rent for and gives them confidence that your property can bring in that income. Next, your property needs to appraise for a value that supports both the loan amount and the DSCR ratio the lender is looking for. A strong appraisal helps ensure your deal pencils out, and it gives the lender the security they need. You'll also want solid credit. Most lenders look for a minimum score around 660 or higher. The better your credit, the better your rate and terms. And you'll generally need to bring a down payment of 20% to 25%. Some lenders may go a bit lower, but that's the range that opens up the most options. The good news? You don't have to provide tax returns, W-2, pay stubs, or explain every line of your personal finances. The property carries the weight of the loan, and that's what makes DSCR loans such a great fit for investors who want to scale without getting bogged down in personal income checks. Another advantage? Some lenders are now offering Dscr cash-out refinances after just 90 days. That means BRRRR investors don't have to wait 6 months or longer to pull equity out and move to the next deal. That's helping investors move faster and keep building.
When Dscr loans make sense?
Dscr loans can be a game changer, but when do they make the most sense? First, they're great for full-time investors or anyone who's self-employed and doesn't have easy-to-explain W-2 income. If your tax returns don't tell the whole story of your financial strength, maybe because of write-offs or business structures, a Dscr loan lets you qualify based on the deal, not the paperwork. They're also ideal when you're trying to scale a portfolio without hitting personal debt-to-income (DTI) limits. With conventional loans, you eventually run into a wall where your personal DTI disqualifies you, even if your properties are cash flowing beautifully. Dscr loans help you keep moving because the lender cares about each property individually, not your entire personal financial picture. Finally, Dscr loans are incredibly useful in BRRRR strategies. They let you refinance based on the property's rental income and ARV, not your personal income. That's especially valuable when you're doing multiple deals in a year and want to keep your cash recycling and your projects moving. And there's another reason Dscr loans are gaining popularity. Properties with a Dscr of 1.2 or higher tend to secure better rates and terms. That means the better the property performs, the easier it is to borrow and the more favorable your financing. If this helped you understand how Dscr loans let you qualify without using your income, hit that like button so more investors can discover this strategy. Drop a comment below. Are you thinking of using a Dscr loan for your next deal, or what's holding you back? Don't forget to subscribe for more clear, practical BRRRR strategies and financing tips. Go watch the next video shown on your screen and click the link in the description if you want help structuring your next loan the smart way.